I have spent a lot of time lately looking at the massive debate surrounding whether it's better to rent or buy a home. And honestly, the advice out there is often incredibly misleading. Most of us grew up with the idea that renting is simply throwing money away, while buying a home is the ultimate sign of financial maturity. The common logic usually goes something like this. If you can find a house where the monthly mortgage payment is the same as or even slightly less than what you're currently paying in rent, then buying is a total no-brainer. But I'm here to tell you that this way of thinking is not just oversimplified, it's fundamentally flawed. My name is Maaz, and in this discussion, I want to take a completely different angle on this decision. We need to stop comparing a mortgage payment to a rent check because they aren't the same thing at all. It's like comparing the cost of a car's monthly fuel to the total cost of owning the entire vehicle. One is a recurring expense for a service, while the other is a complex mix of investment, debt, and maintenance. If we want to make a truly informed choice, we have to look at the total unrecoverable costs on both sides of the equation.
An unrecoverable cost is essentially money that leaves your pocket and never comes back to you in the form of equity or residual value. When you're renting, calculating this is incredibly easy because it's just the total amount of rent you hand over to your landlord every month. That money is gone, but in exchange, you get a roof over your head and zero responsibility for repairs. However, for a homeowner, the calculation is much more elusive. Many people mistake their mortgage payment for their cost, but a mortgage is actually a split between two things: the interest you pay to the bank, which is unrecoverable, and the principal repayment, which is essentially moving money from your bank account into the equity of your home. The principal part isn't a cost, it's a forced savings plan. To truly see if owning is cheaper than renting, we have to look at the three hidden pillars of homeownership costs that many people ignore: property taxes, maintenance expenses, and the cost of capital. I have spent a lot of time boiling these down into what I call the 5% rule, which provides a quick back-of-the-envelope way to see which path makes more financial sense for your specific situation. The first pillar is property taxes, which are perhaps the most straightforward of the unrecoverable costs. Depending on where you live, you're going to pay a percentage of your home's value to the government every single year just for the privilege of owning that land. On average, across many regions, this sits right around 1%. You don't get this money back when you sell the house. It's a pure expense that provides the infrastructure around your home but adds nothing to your personal net worth. Then we have to talk about maintenance, which is the part of homeownership that most new buyers vastly underestimate. Maintenance isn't just about the fun stuff like painting a wall or buying a new rug. It's about the inevitable reality that things break. Roofs leak, furnaces die, and pipes burst. To keep a home at its current value, you generally need to spend about 1% of the property's value every year on upkeep and repairs. Some years you might spend nothing, but then a decade later, you're hit with a $20,000 bill for a new roof. Averaging it out to 1% is a safe, conservative estimate that ensures you aren't caught off guard by the physical degradation of the asset. The third and most significant pillar, however, is the cost of capital. This is where the math gets a bit more academic, but it's the most crucial part of the 5% rule. The cost of capital is split into the cost of debt and the cost of equity. Most people understand the cost of debt. That's the interest rate on your mortgage. If you have a $400,000 mortgage at a 3% interest rate, you are paying the bank for the right to use their money. That interest is gone forever. But what about the money you used for your down payment? That is your equity, and it also has a cost known as opportunity cost. If you put $100,000 down on a house, you are choosing not to invest that $100,000 in the stock market or other productive assets. Therefore, the cost of having that money tied up in your walls is the difference between what your house is likely to gain in value versus what a diversified portfolio of stocks would have earned you over the same period. When we look at historical data, this becomes very clear. If we look back over a century of data, globally, real estate tends to return about 1.3% per year after inflation. Stocks, on the other hand, have historically returned about 5.2% after inflation. This creates a gap of roughly 3.9%. Even if we are conservative and account for more recent market shifts or different tax implications, we can generally estimate that the cost of capital, the loss of potential gains by choosing a house over the stock market, sits around 3%. When you add that 3% cost of capital to the 1% for taxes and the 1% for maintenance, you arrive at the 5% rule. This means that as a homeowner, you should expect to lose about 5% of your home's total value every year to unrecoverable costs. This is the magic number that allows us to compare owning to renting on a perfectly level playing field. To put this into practice, you just take the price of the home you're looking at, multiply it by 0.05, and then divide by 12. If you can find a comparable place to rent for less than that monthly amount, then renting is actually the superior financial move. For example, if you're looking at a $500,000 house, the 5% rule suggests your unrecoverable costs will be $25,000 a year, or roughly $2,083 per month. If you can rent a similar house for $1,800 a month, you are actually saving money by renting, even though it feels like you're throwing it away. Conversely, if that same house rents for $2,500, then buying becomes the smarter financial play. It works the other way too. If you're currently renting a place for $3,000 a month, you can multiply that by 12 and divide by 0.05 to see that your rent is financially equivalent to owning a $720,000 home. This simple calculation cuts through the emotional noise of the real estate market and lets you see the cold, hard numbers. Now, I realize that for some, this might feel like a bit of a head spinner because it challenges the deep-seated belief that a home is always a great investment. We often hear stories of people who bought a house for $200,000 in the 90s and sold it for $800,000 today, and it sounds like a massive win. But when you factor in 30 years of property taxes, 30 years of maintenance, and the interest paid on the mortgage, the profit starts to look much smaller. Furthermore, if that person had invested their down payment and their monthly maintenance savings into a low-cost index fund over those same 30 years, they might actually have ended up with a significantly higher net worth. I'm not saying you shouldn't buy a home. There are many non-financial reasons to do so, like stability, the freedom to renovate, and the pride of ownership. But from a strictly financial perspective, the 5% rule is a necessary reality check. It is also important to acknowledge that this rule isn't set in stone. It's a framework that can be adjusted based on your personal financial situation. For example, if you are a more conservative investor who doesn't like the volatility of the stock market, your cost of equity might be lower because you wouldn't have earned as much in the market anyway. In that case, you might use a 4% rule instead of 5%. Or if you live in an area with particularly low property taxes, that percentage drops. Tax-advantaged accounts like an RRSP or a TFSA also play a role. If your alternative to buying a house is investing in a taxable account where you'll lose a chunk of your gains to the government, the house, which often has tax-free capital gains on a primary residence, starts to look more attractive. But for the average person who is trying to decide whether to jump into the market or keep renting, 5% is the gold standard for a reason. Ultimately, the decision to rent or buy is one of the biggest financial moves you'll ever make, and I want you to go into it with your eyes wide open. Don't let a mortgage broker or a real estate agent convince you that renting is a waste of money without showing you the math on the unrecoverable costs of owning. My goal with the 5% rule is to give you a tool that makes the comparison as clear as possible. Whether you decide to sign a lease or a deed, make sure you're doing it because the numbers make sense for your life and your future. I'm Maaz, and I believe that common sense investing starts with understanding where your money is actually going. If you found this perspective helpful, think about the people in your life who are currently struggling with this same choice and share these concepts with them. Real estate is a powerful tool, but like any tool, you have to know how to measure it correctly to get the best results. The American dream of homeownership is great, but a dream that drains your bank account because of bad math can quickly become a nightmare. Stay grounded in the numbers, stay objective, and always look for the unrecoverable costs.